the room already. Welcome. Good morning. I'd like to start this keynote with a little walkthrough time. I did a little research. I wasn't really so familiar with the history of banking. Since 2000 BC, when merchants began making loans to farmers and traders who transported goods from one city to the next, this marked the launch of what we now know as banking today. Now, some would argue that the 14th and 15th centuries were critical for Europe in terms of developing a banking system. Banking houses emerged in Italy, and later in the 17th century, the Dutch Republic. And then, of course, from the 18th century onward, London has ruled the banking world in Europe. But I know what you're thinking. You're thinking, Sean, I didn't get up at 6 this morning just to show up to this conference and get a history lesson on banking. The coffee isn't strong enough. I went outside earlier, and it doesn't matter how much coffee you have. It will not keep you awake during a 30-minute presentation on the history of banking. So if you want to learn about classical European banking, head back to university. And so let's move on and talk about something a little more modern. This conference is about modern banking and the changes that are taking place today and in the future. So let's fast forward to 1983. I might suggest that this is really the dawn of online banking. In that year, the Bank of Scotland began offering internet banking in the UK through its HomeLink service, which involved the connection via a TV and telephone, landline, of course, to send transfers and pay bills. That service formed the framework for online banking as we know it today. Now fast forward again to 1994, and in that year, 100,000 households began accessing bank accounts online using Microsoft's Money personal finance software. Shortly thereafter, the Stanford Credit Union created the first online banking website. By the end of 2001, 8 US banks had 1 million users online each. By 2005, we had direct banking both in the United States and in Europe. This really marked a new era where progressive customers no longer needed to visit a physical bank. Around this time, financial regulations started to appear to implement stronger remote access security options. And then in 2007, we had a revolutionary new product. That was the Apple iPhone. And with that brought the idea that you could access all of your banking services from all corners of the world. And then by 2011, we knew that online banking had become mainstream, as evidenced by the fact that the majority of elderly Americans preferred online banking to going and visiting a traditional banking branch. Finally, in June 2016, internet payment service PayPal took its place in the Fortune 500 list for the first time. So that's the history of online banking, but I want to talk about the future. So let's do a little exercise. Now I want everybody in the room, stand up. I know you need some exercise, to keep you awake, so that's important. All right, now I want everybody from, about here onward to sit back down. Okay, yeah. So the rest of you can remain standing. So that's roughly 54%. That's the proportion of finance jobs that researchers believe will be automated away by 2030. Do I have your attention now? Now, of course, you can all sit down now if you want. Keep standing if you need to. I know the standing desk thing is quite a phenomenon now, so if you need to stand, feel free. Now, of course, I acknowledge that some of you will be retired by then, if you're fortunate. And for those of you, I'd say bon voyage. But for the rest of you who, like me, want to be relevant in the workforce by 2030, listen up, because I've been thinking a lot about the changes happening now that will affect us in just 12 short years. Finance is rapidly evolving, and driving that rapid evolution is the world of startups. So I want to kick off this a bit by familiarizing you with some of the innovations driven by startups to accelerate the growth of digital banking and help prepare you for success over the coming years. I genuinely think that understanding banking through the eyes of these startups will help prepare you for the inevitable changes being driven by automation. I admit bias in this presentation. Since moving to Prague, I've worked non-stop with fintech startups. In my view, whether it be in payments, personal investing, lending, or other areas, banking is an area that is ripe for digital development. And equity backers like VCs are starting to take notice. The second quarter of 2018 saw a global total of $20.34 billion in equity funding across 383 deals. Indeed, we're on track to see a record year in 2018. Now, as we're in the heart of Europe, let's discuss the numbers for this region. Fintech VC-backed equity funding in Q2 2018 reached $852 million across 72 deals. But when you consider that there are 2,265 VC funds registered with Crunchbase in the EU, you can see that there is plenty of money to go to great ideas, at least in theory. Now is a wonderful time to be an innovative startup that can execute. But now is also a great time to be a bank with a huge cash reserve. Let me explain. I see the race as fintechs versus banks, and the winner will be the one that can master the other's domain first. Let's just juxtapose that. Fintechs have mastered digital platforms, but they haven't yet proven that they can scale product lines. Banks, on the other hand, offer a wide product range of product lines, but I haven't seen sufficiency in terms of digitalization. Indeed, that's why this conference and the one later in the week exists. If you're a bank and you're wondering how you can grow portfolios, start with the fintechs that have the easiest touch points. Take alternative checking accounts and e-wallets as an example. An investment into a fintech that has understood the benefits of banking simplicity might be a great target for a bank that sees the benefit of onboarding a new generation of customers who might be seeking a line of credit to, say, start a freelance business. Why is that important, you might ask? Well, we can observe some interesting developments in fintech. One trend I'd like to point out is that fintech startups are starting to help other startups. Brex and Divvy are two such leaders, and indeed Aprilia in Norway and Pleo in Denmark are leading the way. Personally, as a guy who is working with fintech startups every day, I'd love to see something like this in CEE. You could imagine a bank making a killing through an acquisition of a fintech that really understands the startup market. And no doubt, I expect to see more diversified offerings. Over the next year, I think we will see many opportunities for more omnichannel strategies. There exists an opportunity, even in this market, to combine credit cards with debit cards, with multi-currency accounts, with trade finance accounts, and investment accounts. Now I want to switch gears, and I want to move to a topic somewhat related to fintech, ICOs and blockchain, which is the technology underpinning ICOs almost by definition. Now, why should bankers be interested in ICOs and blockchain? The first 5 months of this year, we saw nearly doubled 2017's total of $7 billion. Moreover, from 2013 to 2017, ICOs only raised $7.4 billion, most of which came last year, indicating that this space is booming. Last year's figure was raised across 552 ICOs versus 537 so far in 2018. But 2018's success has been propelled by a couple of notable ICOs. Almost half of 2018's funding came from the Telegram ICO, which raised $1.7 billion, and in the end didn't involve public fundraising thanks to the challenges posed by the United States Securities and Exchange Commission. Then there was EOS, which raised a whopping $4.2 billion in a crowd sale that lasted about a year. These are outliers bringing up the per ICO and monthly averages. Having said that, the industry is still fraught with failed projects, with 80% of initial coin offerings conducted in 2017 identified as scams, according to Status Group. Failure is, in simple terms, when an ICO fails to make it onto an exchange. So ICOs are one area for banks to monitor, but what about the blockchain as a whole? The blockchain last quarter saw a strong $633 million in VC-backed investments globally, though this still pales in comparison to ICO funding. This tells us that VCs are, unsurprisingly, not interested in the level of risk that ICO-funded blockchain firms are offering. And there's a good reason for that. But still, there's no doubt in my mind that legitimate startups focused on the blockchain can make meaningful contributions in the fintech community. Indeed, M&A activity in the crypto space is doing really well, suggesting that not all crypto firms are headed to the graveyard. Goldman Sachs-backed Circle bought Poloniex earlier this year for $400 million. Then Coinbase went on a buying spree with acquisitions of Cypher, Paradex, and then Earn.com. The latter was a $100 million deal. There are no shortage of examples. Now, if you're still in doubt about the power fintech can have on your client base, let's look at fintech alternatives, two unicorns as the VC world calls them. Combining cryptocurrency with fintech seems to be an emerging trend. Revolut saw their user base double after they began working with cryptocurrency. Now they have 2 million clients. Robinhood increased their client base by a third to 4 million users after targeting cryptocurrency holders. I do believe that for those bank replacements that are truly successful, banks will continue to pick off fintechs that find a hold in the market. The third way that startups are changing the banking industry is through one of my great fascinations, artificial intelligence. Though there are a handful of successful general AI startups, including firms like Vicarious and Kindred, most AI firms focus on a particular area. For this reason, we now see companies that are claiming that they are the AI for X. Let's look at a couple of examples. Intelligent X in the UK wants to bring the first AI brewed beer. Now, I'm not sure how that's going to go over in beer-loving places like the Czech Republic, but having been to the Pilsner Urquell factory and brewery, I can imagine some resistance to the concept of computer-crafted beer. Deep Fish in Russia wants to use neural networks to locate, well, fish. I'd like to think of them as the next great fishermen. Hoofstep in Sweden is bringing deep learning behavioral analysis to horses, of all things. I'm not sure if the horses will kick back, but certainly they're well on their way. There's even a company in the US called Prose, and they're creating artificial intelligence-backed made-to-order hair care products. I mean, when you see an idea like that, you think there's really no bald spot for AI development. For those looking for a relaxing evening, artificial intelligence for cannabis is well on its way. Deep Green uses this to produce the world's best weed. I can't say this from experience, but this is what I hear. Personally, I'm excited about AI for HR tech because I think I'm quite passionate about increasing hiring quality and employee satisfaction. So lots of opportunities there. Now, of course, there are plenty of artificial intelligence firms that would suit banking operations departments as well. Before I dig deep, let's think about the potential, though. According to financial research firm Anonymous, AI represents a $1 trillion opportunity for the financial industry by 2030. With AI, traditional financial institutions can save 22% in costs. That's remarkable. And now, what does it mean for banks specifically? AI will bring $490 billion in savings to the front office. Almost half of this, $199 billion, will come from reductions in scale of retail branch networks security, tellers, cashiers, and other distribution staff. AI will bring $350 billion in savings to the middle office. By simply applying AI to compliance, KYC, AML, authentication, and other forms of data processing, banks and credit unions will save a staggering $217 billion. Finally, the back office will realize $200 billion in savings. $31 billion of this will be attributed to underwriting and collection systems. Returning again to research from Anonymous, we can envision three primary ways in which artificial intelligence will transform the banking community. AI technology companies such as Google and Amazon will add financial services skills to their smart home assistants. They will leverage data plus interface via relationships with traditional banking providers. Technology and finance firms will merge and/or collaborate to build full psychographic profiles of consumers across social, commercial, personal, and financial data. We've already seen this with Tencent's coupling with Ant Financial in China. The crypto community will build decentralized, autonomous organizations using open source components with the goal of shifting power back to consumers. Finally, AI-enabled devices are already using vision and sound to gather information more accurately than humans can. Software continues to get more human-like, and already software can visually recognize your customer before your staff does. Lest we leave them out, I'd like to point out three of my favorite examples of cutting-edge AI in consumer products. I would note Apple's A11 and A12 Bionic chip has a type of neural engine to process machine learning and facial recognition tasks. Tesla makes use of AI in its autopilot feature, and Intel's Myriad X chip brings AI to consumer products in massive quantities. Now, I'm open to suggestions. If anyone has any other items to add to this list, favorite uses of AI, feel free to speak up. I'm always looking to add to this list. So the expectations are high. But does that mean that artificial intelligence will begin seeing big investments in Europe? Well, despite my excitement for AI, I'm not sure that this excitement is shared by people in this room. AI-related equity funding in the US totaled 38% of the global share. In China, it was bested. It was outpaced at 48% of the global share, leaving only about 13% for the rest of the world. Now, I hope everyone here would see some room for improvement. Ignoring the numbers from before, just imagine a world where AI can improve your bank's operational efficiency by just 10%. For some banks, that's a huge competitive advantage. At the very least, you wouldn't want to be the last guy to draw your gun. So AI is starting to drive a new type of platform, and it's called AI-infused expert automation and augmentation software, or EASE, first developed by a firm called MindBridge. Now, machine learning does what it should do best: finding data and process patterns and automating tasks. Expert automation and augmentation software utilizes human cognition. The human expert augments machine learning supervising and intervenes in the cases that require human skills and context that are often missed by machines. These platforms will usher in a new era of AI-assisted or AI-enhanced productivity, which will change firms like legal, computer programming, teaching, language coaching, and even investment banking. I'm also researching a new development called capsule networks. Capsule networks offer the promise of less programming than current offerings. And that's really important because the thing about AI is that it isn't cheap. $500,000 salaries are now starting to appear in lucrative markets like China. A 10-cent report, yeah, so if you're looking for a new job, do some AI in China. A 10-cent report suggests that a mere 300,000 people are now working in AI, but company needs are expected to require 1 million or more AI engineers. At some point in the next years, we will not be able to separate machine learning as separate algorithms. And I believe that the expectation is that some form of artificial intelligence will be inclusive in all new products. AI will be ubiquitous, whether banks in the region realize it or not. So early adoption is a huge competitive advantage. And this is partly the result of an increasing number of AI-based open source projects. Already, Google is promoting an artificial intelligence yourself project, a sort of DIY AI that any programmer can use to develop applications ranging from voice recognition to facial expression recognition, all with, relatively speaking, little know-how. Since 2013, around 42% of the AI companies acquired have had VC backing. So those are my thoughts about a couple of the most interesting investment areas right now for me. One of the challenges that confront startups in this region is the lack of experience scaling a great idea to unicorn status. That is, a company with a market value of $1 billion or more. As we're in Prague, I'll speak for a moment about the Czech Republic. How many people are here from the Czech Republic? Was this like 2.5? You're half from the Czech Republic? Fair enough. In the Czech Republic, we haven't really created our own homegrown unicorn. And I think that's because, not just because we're a long way from Silicon Valley in geography, but because we're a long way from developing the ecosystem needed to support it. Indeed, VCs haven't had unicorns to invest in. So I've asked around, and it seems like there are a few things that are lacking here. Many smaller ecosystems have a healthy density of early-stage startups, but lack a concentration of late-stage companies. Prague and other places in CEE lack a late-stage ecosystem. It's really hard to do a seriously large funding round here. And it comes from a combination of geographic issues, of course, but also education issues. Many of the people I meet in the Czech Republic are uninterested or even downright resistant to competing with the world's best, whether it be in terms of language or advanced education. And talent shortages, as well as a dearth of government support organizations and general lack of awareness about what it takes to develop a billion-dollar IPO, also hampers the country. Moving eastward to Slovakia, you'll also find difficult economic issues for the people to grapple with. Though anecdotally, I would observe greater willingness for self-improvement. The bottom line is this: if you've never been involved in producing a unicorn, it's awfully hard to do it the first time. The Czech Republic hasn't the experience, and it will take an extraordinary effort to make that happen. Let me illustrate with a story. I was speaking with another expat a few months ago, a guy from Ukraine, as I recall. And he was telling me about an interesting consulting experience he had at the Czech National Bank. His area of expertise is cryptocurrency and digital payments. And I think this happened a couple of years ago. He mentioned that he had been asked to speak to an audience of what he called old gray-haired ladies at the Czech National Bank, and on the topic of cryptocurrency. And he had sat through a few of these like 1-hour sessions with them. And they were going over the ins and outs of Bitcoin and Ethereum. And at the end of the 5th session, one of the ladies, in a rather exasperated way, said, okay, enough about this virtual money, but what does it look like? And therein sums up the challenge, I think. It's hard to educate people on new topics. And we all think we understand the banking world because banks have been around since we've been around. But most of us understand it as it has been. I'm here to encourage you to think about how it can be. Now, I was having lunch with another guy recently, a tech company executive, whose responsibility is to oversee all of the countries represented at this forum, actually. And we were talking about how we can harness the unique engineering resources of the Czech Republic to develop something special, something sustainable. And we agreed that governmental agency support here is lacking. Indeed, there is a company in the Czech Republic called, an agency, I guess I should call it, called Czech Invest. but we both agreed that we couldn't quite understand what they're doing to advance startups, other than, in the words of them, provide some office space. Now, we took that to mean that they're not offering much more than a modern library for startups to work in. But instead, we came up with some ideas. We came up with the need for a program that combines workspace, yeah, okay, fine, that's generally the least of anyone's concerns, but with private expertise, with investors, with government lobbying, private support from tech providers, and with banks. And I submit to you that banks are better off engaging startups early rather than late. And they should be leading this effort rather than following along aimlessly. Now, I'm not saying that the Czech Republic and CEE is never going to be a world leader in startups. And I'm not saying that banks have totally missed the boat on this one yet. I do think there is hope, but I want to encourage everyone here to think about the kind of role they can play to bring us all to that place, because the more proactive you are as a bank, the better you will be prepared for the evolution of banking. The next year promises much opportunity in fintech, blockchain, artificial intelligence, and ecosystems. I hope each of you think about how developments in these areas can positively impact your banking operations. Do not be discouraged. These are future drivers of your business. Think of this keynote as an introduction of sorts to your education in this area. Now, my name is Sean Patterson. I'm the head of strategy at Euro Digital Partners, a global partnership of creative professionals and founder of EDP Capital, a startup consulting wing of Euro Digital Partners, whose goal is to match great startups with great investors. And I want to thank you for your attention for these moments, because I think this is going to be a great conference. I think it's got a lot of topic diversity, and I really think it will help you make sense of digital changes emerging in a traditionally analog world. I encourage you to learn more about me at startups.eurodigitalpartners.com, and I would also ask you to say hello to me later. I don't bite. I love to hear about new developments in banking and the people working to make them a reality. So thank you for your attention, and on with the conference. Thank you.